Welcome back to Investing Talk Podcast.
Today we're looking at Alamos Gold.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Yeah, let's. For a long time, Alamos Gold kind of flew under the radar.
It really did. It was seen as, stable, reliable, maybe a bit boring.
Exactly. Low volatility, which is nice, but not exciting.
But their recent Q1 2025 results, they didn't just surprise people. They really changed the whole story.
How so?
They revealed a deep structural operational strength that I don't think many had priced in.
That's the key phrase right there. Structural strength. This wasn't just a lucky quarter.
Not at all. This looks like the payoff from years of, smart engineering and investment finally coming through.
Okay, so let's look at the numbers. The production was strong.
Very strong. They sold 51,600 ounces in Q1.
Which is about a 9.5% increase year over year.
Right. But as you know, in mining, the real story is always about costs.
Always. It's what separates the winners from the losers.
And that's where we have to focus. On the all-in sustaining cost, or AISC.
Which, just to remind everyone, is the true cost. It's not just digging ore out of the ground.
Exactly. It's everything. Admin, capital, exploration, all of it. And Alamos Gold, they dropped their AISC dramatically.
Okay, to what number?
To an astonishing $1,145 per ounce.
Wow. In Q1 2025.
In Q1, that's down over 10% from the previous year.
And to put that in perspective, a lot of their competitors are running in the $1,300–$1,400 range, right?
Comfortably. So hitting $1,145, that suddenly puts them in the top tier globally for cost efficiency.
That is a staggering achievement. They were guiding for something much higher, weren't they?
They were. Their own guidance was closer to $1,310 for the full year.
So they beat their own conservative estimate by nearly $165 an ounce.
Which completely changes the profit picture for the rest of the year, especially with gold where it is today. It creates instant, massive margin expansion.
And that kind of efficiency doesn't just happen overnight.
No, it's the result of strategic capital projects finally coming online.
So what was the specific switch they flipped? Where did this jump come from?
The main driver was the completion of investments at their cornerstone Canadian asset.
The Young-Davidson mine.
That's the one. It was a long-term project to boost processing capacity. They took the plant from 5,500 tons per day all the way up to 7,200.
That is a huge increase for an existing mine. So they're pushing more ore through with the same basic overhead.
Precisely. And that's the operational leverage that just crushes the AISC number down.
And that flows to the top line.
It does. Revenue increased to about $188 million, a nearly 7% jump year over year.
So the bottom line result of all this fine-tuning.
The adjusted EBITDA margin expanded to 41.2%.
41%. That's the kind of margin that really separates the best producers from the pack.
It confirms this is a repeatable structural advantage they've built.
Okay, so they are generating serious cash. But I always want to know what they're doing with it. Let's shift gears to the balance sheet.
The balance sheet is a fortress. Plain and simple.
What's the cash position look like?
They exited Q1 with a phenomenal net cash position of $362.7 million.
Net cash. So that's cash minus debt.
That's right. They have almost $400 million in cash versus just $35.5 million in total debt.
And I noticed something about that debt. It's listed as non-recourse project financing.
Ah, yeah, that's a crucial detail.
Can you break that down? Why is that such a good thing for the company?
Of course. Non-recourse means that loan is secured only against the assets of a specific project.
Not against the whole company.
Exactly. So if that one project failed, hypothetically, the creditors couldn't come after the rest of their corporate cash or assets. It's highly de-risked debt.
That is incredible protection. But let me play devil's advocate for a second. Is carrying that much cash over $360 million actually inefficient?
It's a fair question, but in mining, it's highly strategic, especially when you look at their capital needs.
What's on the horizon for spending?
They have a CapEx plan for the next 3 years, totaling about $120 million.
Okay.
Their cash on hand and their free cash flow, which was $85 million in Q1 alone, can cover that entire plan multiple times over.
So zero risk of shareholder dilution. They don't need to issue new stock to fund their growth.
None, which is a huge plus. And when a company's this secure, they start returning that capital.
Right. We saw the dividend, about $25 million. But the big signal was this share repurchase program.
The $50 million buyback, that's a very powerful signal.
It's the first one they've done since 2018, isn't it?
It is. It tells you management sees the stock as deeply undervalued, and they're willing to put that cash pile to work. They're walking the talk.
This all brings us back to their foundation, the assets, where they are and what they're mining. Jurisdiction risk can sink any miner.
And they seem to have insulated themselves from the worst of it. Their moat is built on stability and quality.
So where are their operations?
Exclusively in places considered mining-friendly: Canada, Turkey, and Mexico. It's a deliberate strategy to avoid the headaches that plague their peers in less reliable regions.
And it's not just the location, it's the quality of the rock itself. That low cost we talked about is supported by the ore grade.
That's the engine. You look at Young-Davidson again, it has an average reserve grade of 4.4 grams per ton.
And what's the industry median? Much lower, I'd imagine?
Much lower, closer to 1.2 grams per ton.
That is a stark difference. It simplifies everything.
It does. They spend less to pull out way more gold per ton. And this combination, high grade and stable places, lets them look at future growth differently.
How so?
Their growth path is highly de-risked. It's mostly brownfield expansions.
So expanding existing sites, not starting from scratch.
Exactly. It minimizes execution risk compared to peers who are banking on these massive multi-year greenfield projects. Alamos Gold's growth is, in a way, already baked in.
Okay, so we have this picture of expanding margins, fortress balance sheet, high-grade assets. How is the market responding? What are the technicals saying?
The market has definitely noticed. The technicals confirm a strong shift. The big one was the Golden Cross back in March.
The classic momentum signal.
Yeah.
The 50-day moving average crossing above the 200-day.
Precisely, and that signal aligned perfectly with the Q1 data release, which was like a green light for institutional funds, and you can see that money flowing in.
And what are the signs of that institutional accumulation?
Institutional ownership is now up to 71%.
That's very high.
It is. It shows long-term conviction. We've seen Vanguard increase its stake by 2.7 million shares. BlackRock added 1.3 million.
And you can't ignore the insiders.
Never. The CEO himself purchased a total of 275,000 shares between February and March.
Management is putting their own money on the line.
Absolutely. So you have strong technicals, heavy institutional buying, and insider conviction. It's no surprise analysts are revising estimates upward. We saw one firm raise its price target to $10.50.
So looking forward, what are the catalysts investors should be watching for on the calendar?
The next few months are catalyst heavy. First up is the Q2 earnings release around May 14th.
What are people expecting?
Strong earnings for sure, but the main event will be the updated guidance.
Because they have to incorporate this new, much lower cost reality.
Exactly. We expect they'll lower their full-year AISC guidance, signaling that Q1 wasn't just a fluke. Then, all eyes on June 9th.
Investor Day. What's so important about this one?
This is the future roadmap. They're unveiling updated reserve life maps and, crucially, guidance for 2026 and 2027.
It may be news on the buyback.
I'd expect some detail on accelerating that $50 million program.
Okay, so beyond those dates, any other catalyst to watch?
Yeah, keep an eye on exploration, new drilling results from their El Castillo project in Mexico, and any regulatory news on the La Carolina expansion. These are smaller, but they reinforce the growth narrative.
And all of this is happening with a pretty powerful macro tailwind.
A huge tailwind. Gold prices are holding strong above $2,300 an ounce.
And the Fed.
The market has priced in rate cuts starting around September 2025. That dynamic high gold price, lower rates is extremely favorable for gold miners.
So a very strong case. Now, we have to pivot. What are the main headwinds? What are the primary risks here?
The two big ones are inherent to the sector. The first is gold price volatility.
Right, they don't have a hedging program.
Correct. They are fully exposed to the spot price, so they capture all the upside, but they'd feel the full brunt of a downturn.
A drop below, say, $18.50 an ounce would really pressure their cash flow.
It would, but this is where that fortress balance sheet is the ultimate mitigation.
The cash cushion.
That $360 million net cash position is an unparalleled shield. They have staying power that indebted peers just don't.
And the second risk, you mentioned country risk earlier.
Right, the country risk concentration, specifically in Turkey, the island Christina mine is about 25% of their production.
So that's exposure to currency volatility,
Yep.
potential tax changes.
It is.
Huh.
But operationally, that risk is pretty well contained. 87% of their revenues are in US dollars, which buffers the currency effect.
And the tax situation.
Crucially, their current Turkish tax regime is locked in by agreement until 2028. So any immediate uncertainty is off the table for the medium term.
So when we put all these pieces together,
Mm-hmm.
the operational execution, best-in-class costs, that massive cash cushion, this feels like a company that's uniquely positioned for a re-rating.
I agree completely. Alamos Gold offers what I would call asymmetric upside. The combination of financial health, expanding margins, and low-cost assets in stable regions really sets them apart. And it raises a provocative question for you, the listener. Does this operational and financial superiority make Alamos Gold an exceptionally attractive kind of gift-wrapped M&A target for a major producer looking to buy high-quality, de-risked assets?
A potential takeover catalyst on top of internal growth. That makes for a very compelling picture. Thank you for walking us through that.
My pleasure.
And thank you for joining us on this look into Alamos Gold. If you enjoyed this analysis, be sure to subscribe, like, and comment to support the show, and we'll catch you on the next one.